All right, and we're live. Hello, everyone, and welcome back. Couch Investor here with Arny. It's Friday. We're going to discuss the Palantir earnings report, a couple of comments that were made during the earnings call that you might have missed. Of course, much better report, in my opinion. I think it was one of the best earnings calls as well. We've come a long way. We've come a long way from being down a lot stock wise, business wise as well. Momentum was a bit lost. So yeah, we're going to discuss all of that. Of course, if you have questions, leave it in the comments. Go follow Arnie's channels on YouTube. Go follow him, especially on X as well. By the way, since the last time we did a live stream, I was now at 4.9 million impressions. So hopefully I can push that to the 5 million and finally get some Elon money. But we're gonna have to wait.
Almost there.
Almost there. So yeah, first I want to hear your comments, like highlight comments from what you liked, what you didn't like, maybe from that earnings report, and then we're going to talk about a bit about the earnings call. I highlighted a couple of things on the transcript, so we can go over that later on.
Well, the thumbnail of this live stream is just warming up. And that's exactly the feeling I also had. It's like the pre-workout, the pre-warm-up was actually quite long and suffered. But here we are with finally seeing the Palantir that we envisioned in our head, how things should have been. We see them gradually becoming them. And Palantir had this big problem. It's like you are a top influencer, a top content creator in terms of what you deliver, but nobody really knows how good you are. Therefore, you can't really grow. And how you solve that? Well, you need to get in touch with the right audience, with the right way. And that's exactly what Palantir has finally, I would say, done with its new product, AAP, which doesn't seem only to sell like a weed, as Karp mentioned months ago, but it is actually changing the entire dynamic of the business internally, because it has become way more efficient, but also the sales dynamic that basically eliminated the big bottleneck that Palantir suffered from. Initially, the big problem was, I have this product, it is very hard to just convince you to start a pilot. The pilot was very long, 3-6 month length, very costly, therefore also for Palantir, because it's a pilot, so you need to absorb a lot of cost. And now, in 3-5 days, the client goes happy home, and that client, along with other maybe 10-20 clients all together in one event. This dynamic changed everything, and finally we have been seeing this thing that started a few months ago actually starting entering the numbers. So I'm amazed by the numbers that finally it is not just a company that is barely growing, but this dynamic of the new product AAP has finally unlocked, or I would say is warming up the true unlocking of the value. And for instance, the first thing that I noticed that made me super excited is this shift. Palantir had been guiding revenue in decline, like in deceleration for basically every quarter since the DPO. Like the best we had was in Q1 2022 that they just reiterated a 30% growth, but we never assisted to an increase in the revenue growth expected. And last quarter it was the first signal from 12% revenue to around 16% guided for this quarter. And this quarter, they delivered approximately that, even 1% better. And actually, they guided for a 19% revenue growth. So if I can share the screen, you can see exactly what I've been saying here. The revenue growth was expected to stay flat, and that's the best we had since the DPO. After that, it seemed like a depressing story. A company that surfed the COVID wave and then just slowed down perpetually until these very few last quarters, where the dynamic finally changed, And this was driven by both the general interest in AI. Palantir has been building these solutions for almost 20 years. And finally, people are realizing, hey, this stuff actually is interesting. It works. And the product offering AAP that we just mentioned that changed the dynamic of the business. So it's not only existing customers expanding, but a lot of new customers starting contributing to the revenues in a very short period of time. This makes a huge difference. And actually, I would say this dynamic that is so good actually make us don't really look at the negative side of this report, which was the net dollar retention, which was not bad, I would say very bad, at 107%, meaning that the existing customers just expanded by 7%. So the customers, as of last year, just expanding 7%. It means that some customers didn't expand. Maybe they lost some customers. SPACs didn't help on that number. And a lot of friction in Europe was mentioned, especially on the commercial side. Who knows what truly happened there? The counter side of this number is if they reached 16%, 17% revenue growth with existing clients just expanding 7%, it means that the new customers contributed for around 10%. That's 2x, no, that's actually more than 3x the average that we had previously. So this number alone has a huge implication, because if Palantir can actually sustain this growth from new customers, that is already like a 10% added in the growth every quarter potential.
And with the net dollar retention, I believe they does not include revenue from new customers that they acquired in the last 12 months. So we probably will see that number. Maybe it hit the bottom at 107% or so, but I think I will probably just present this, which you can see right here. They say net dollar retention was $107, impacted primarily by headwinds from our commercial business in continental Europe. Net dollar retention does not include revenue from new customers that we acquired in the past 12 months and is therefore not reflective of the recent acceleration in our US commercial business, which of course we know that by now the US is much better for that business than everything else. Of course, they talked about government being a bit slow right now, but they also said they were probably going to see some reacceleration there. But yeah, US business is booming, especially with commercial. And 107 is definitely no. I know during your live stream you predicted 14%. I said 113, and even that was not low enough. But yeah, Europe, I have a feeling that Karp doesn't really like the European market. He said that comment at the end with regards to Germany, with regard to security. They're just waiting for a terrorist attack to happen.
It seems more the other way around, actually. It seems more Europe doesn't like Karp.
Like he wants to like them, but they make it extremely hard for him to like them, even though he speaks the language. But yeah, it's interesting that Europe does not. Even in the UK, we've all watched this interview already that he did not so long ago, talking about the NHS, and then but what about the data and what about privacy? You're going to sell the data. They're like, yeah, but we've never sold the data. And then they're like, yeah, but maybe you might in the future. It's like, okay, but
it's like
maybe we will not. The government.
They always want to find the way to put bad light on them. That's the impression.
Yeah, no, it's a very childish argument. Like, oh, we never did it before, and then they're like, yeah, but you might do it in the future. It's like saying, okay, the government is taxing me 40% now. Maybe you will tax me 50% in the future. Yeah, but we never did that. Yeah, okay, but you might. Who knows? It's very ridiculous. But yeah, going back to Palantir, I want to touch on the on the boot camps. I did a post not so long ago on X. The boot camps, in my opinion, was something. I mean, whoever came up with that, I hope he got a raise, because it's great. Going from zero to use case in 5 days or less, it's much better than having these stupid sales calls that never delivered anything great.
Who do you think came out with the idea?
No
If
clue.
you have to guess.
I don't think it's one of the higher ups. That's for sure. I don't know. It has to come from maybe a new salesperson that they hired. To be honest, I don't know. But I mean the comments that we've gotten, and then you can share a bit more. Here, we're on track to conduct boot camps for more than 140 organizations by the end of November. Nearly half of those are taking place this month alone, which is more than the number of US commercial pilots we conducted all of last year. And then a couple of comments here from the attendees. So one said they achieved more in 1 day for them, which Palantir achieved more in 1 day for them with AIP than one of the top 3 hyperscalers had accomplished over the past 4 months, and then presented their work with Palantir instead of the hyperscalers to the CEO. Another one said here, we basically build 10 times faster and with 3 times less resources. Another one said, we have built in 1 day what they wouldn't be able to get internally in months, and then it probably still wouldn't meet the requirements. I mean, it's pretty amazing how something that simple, I mean, simple, it's a boot camp. It's not, you don't have to come up with a chemical solutions to get to this point, can get you so many good results and traction. Because I mean, like Carp said, this is just the start.
Isn't it like for a YouTuber when basically you just realize, oh, I'm doing the thumbnail wrong, and that changes everything for you. But the content is exactly the same, just the way the people enter in contact with you. If you make it badly, basically you can have the best content in the world, in this case, the best product in the world, but nobody will ever discover. And if you package it well in a way that communicates with their need, then boom, everything starts on lock. And what's truly amazing is that we don't just have a one-off, okay, now we have a quarterly acceleration, maybe 1-2 quarters. This thing potentially can change completely the direction of a business. So that's why I'm excited. I'm more excited to see this finally happening, something that it was there in my mind as something that should have happened. But finally seeing it happening makes me way more excited to see the stock price increasing 20%. I mean, I'm happy for that. But the big thesis I had was the hints that I gradually got over these 3 years. I've been studying Palantir not closely, I would say maniacally, brought me to think it is only a matter of time before the machine that they are building in terms of software infrastructure they sell, but they also use internally, will actually start having this flywheel that goes faster and faster. There were very good signal actually in 2021, early 2022, that this flywheel was getting faster. The number of customers acquired per quarter was increasing every quarter. And I thought, okay, here we are. And then this is the moment. Then we know that there basically a cloud recession, very severe, happened. A lot of freezing of IT projects. Everything changed for the segment. Also, Palantir suffered. They benefited from having very high standard clients that gradually expanded. But we can say that the sales motion was truly working. And with this relatively simple but very effective tool of the bootcamp, basically they are able to leverage on exactly their strength, which is the product. And with that, they don't really need to hire many salespeople. Like, I think the underweighted observation about bootcamps is that these bootcamps are not run by salespeople. Palantir doesn't really like the sales culture of the typical SaaS software. For instance, if you look at Snowflake sales employee composition, you have R&D, which is relatively small compared with the number of salespeople. Basically, Snowflake is a company with a thin product, relatively low R&D, justified by the fact that in order to expand, to create new products, they are in an M&A machine, while Palantir is not buying anything for 15 years. And a very big sales and marketing department. Basically, thin software sold very, very, very well. The product can be actually also nice. I mean, I'm not arguing with the quality of Snowflake product, but this dynamic moves the weight of the organization not from the engineering culture to the sales culture. And Snowflake is a very good company in selling the product. Palantir, on the other hand, actually struggled with sales since the very beginning because they are a very engineering-focused company. And typically, where you have very strong engineers, you don't really talk the same language of salespeople. Salespeople just want something easy. They can sell at a steak dinner. The client understands what it is. The client is happy, buys from you. While for engineers, it is always a matter of solving the biggest problems possible, which tend to give solutions that they work but are not easily digestible. And Palantir had this huge machine Foundry that was very difficult to digest, even from people studying it very closely, trying to understand, okay, but Foundry, it seems it does everything. So what it does? So if Palantir can actually grow with relatively few salespeople and using the engineers it has, also very young engineers. There is this guy, Matteo, who joined Palantir relatively recently, and he basically made one of the very first, if not the first, bootcamp. So it's nice to see young engineers directly working on the products with the potential customers and not low-end customers, but high-end customers with the top management. So that simple thing changed everything in the business and really leverages the key strength Palantir has shown so far. So I'm super excited about the business development side.
Yeah, because when we look at this comment here, like Alex Carr said, our go-to motion now in US commercial is so efficient. So as you could basically look at, it's 10 times more efficient. They're ramping up as fast as they can. Of course, he said like when you're growing 50% your business, you have to throw all the money at that because why not? And he basically says here, like, we're not constrained by dollars. We're constrained by, do we have the people that actually know the product? And like it says here above, they're still investing. I mean, R&D is up sequentially 11%. So they can be profitable, they can grow, they can invest in the business as well. But for them, the thing is, to have the right people, because it is a complex product. You are going to tackle complex problems for other companies. So you don't want to have that, I don't know, traditional account manager or account executive from another sales team come in and like, oh, okay, we have a software to sell you, la 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 la. And then the other side says, yeah, okay, this is my problem. This is what I have to do. Can you help me? And then it's like, oh, oops, sorry, I'm just here to sell you a product. I can't really help you further, which obviously does not work with a company like Palantir, which, yeah, at the start it was a problem, right? We've all acknowledged that sales teams needed to be better. They needed to be better at selling the products that they have. I mean, sometimes I still have difficulty listening to Carp. I mean, at the start of AIPCon, it was just a ridiculous 10, 15, 20 minutes talk about whatever, but maybe that was unexpected because I think Sampo didn't show up, so they had to make up something. But yeah, I mean, it's exciting times for Palantir. I've always said that during these troubled times, macro, geopolitical, whatever, I think a company like that is going to thrive. It's just a matter of when, not if. But yeah, I mean, I did highlight another thing I wanted to show, which probably already disappeared. Great. Oh yeah, well, go on.
What you shared before, I think it is very important. Carpo said, once you have something that grows 50% year on year, referring to the US commercial that is finally getting a lot of traction, you theoretically would love to put all the resources you have, and Palantir has $3 billion that potentially could push into that. The problem is it's not a problem of putting money, because otherwise they would have done it. Is you need enough people. Even if you employ all the engineers into boot camps, still you can't really have enough power to digest all the 50 billion, sorry, the 3 billion in cash. Effectively, it's not only you spend in advertising. That's what he meant. There are certain products where the product is there, you just put advertising online and voila. But if you need some people to actually solve a real problem, you need to organize the event. Okay, fine. But you need to have these engineers who know the product and actually can solve a problem for the clients.
I agree. I think there are. It's not a traditional, because they are obviously dealing with government as well. So it's not like, oh, we have a silly software to sell you that can maybe optimize your picture on Instagram or something like that. It's like real world problems that can have real world consequences if it does not work out. I think a lot of people do not understand how crucial it is to have this correct, to have this software correct, to go with good companies, good governments. Because I mean, it's not a silly software. It's a software that has real life consequences. And I'm happy that they're finally having a good go-to-market strategy, even though it's not the conventional one, but it's one that is working, that is showing the customers, potential future customers, look, this is the best thing that you can get. Yeah, go try something else, and then you'll come back and say, okay, we have to try this one. Which again, the bootcamp strategy is great, because the customers are showing others, look, this is what we can do right now. This is what we couldn't do before. So yeah, it's a much better sales strategy. Before I would continue, because I wanted to show you this comment here from Super Valis. I think it's 11 or 12% year-over-year dilution, right? So will you look at this as an anti-revenue and subtract that from their top line growth or not? I want to touch on this because before maybe he's gonna leave or something could get in an answer.
This is a very complex topic. And it is actually so complex that on my Substack, Palantir Bullets, I actually wrote an entire article just on the dilution, because dilution is one word, but it implies many different angles which you need to look at that. For instance, from this comment, it seems, okay, you have the SBC and the SBC generally, and the SBC naturally determined an increase in dilution, so in the number of shares of 11%. And it is not really like that, because the SBC that you see in one quarter refers to the shares that are vesting in that period. But the number of shares diluted increased by 11%, not because Palantir issued more shares. They didn't have any equity capital raise. They didn't, they gave some shares to employees because they vested after 4 years. But the key driver of this change in the number of shares is only attributed to the stock price rising. What I mean with that is, apart from RSU, so restricted stock units, which are the normal shares that Palantir gives to employees, and they vest in 4 years gradually. So imagine the total amount of dollars that Palantir should give to these employees divided by 4 years, divided by 4 quarters. That is the SBC impact that happens. And the number of shares doesn't change from this RSU until these shares are actually vested. So when the employee receives these shares, this increases. So there is a natural increase in the number of shares. But when you see this spike, like 11%, that comes from options. And options are mainly rights that the management had from their equity compensation plans. So you have normal employees typically paid in salary plus RSU, while the management also having stock options. When stock options are not exercisable because the stock price goes down, the number of shares is the same. The diluted number of shares may decrease because these shares are not included. When the stock rises, and that is exactly what happened in Q3, then you have some shares, some options that previously were not exercisable. So basically, it was a worthless option. When the stock price goes above this strike, they can be executed. So they start entering in the number of shares diluted. So the dilution topic is always difficult to digest because if you look at the real number of shares, it didn't increase much. But as the consequence of the stock price rising, the number of shares diluted actually increased, which means that if all the option owners that have these options that can be executed actually decided to execute them, then the number of shares would amount to this diluted number. But it is not pure dilution, because there is also the complication that since it is an option, when the option is executed, the company actually receives that strike. So there is also a cash inflow. So you see that is very complicated and almost impossible to, and I would say also useless, to be too precise into this. This is something that is important to remember. If the stock keeps rising, then some other options would be triggered, becoming accessible, so the number of shares would actually increase. But that is why I've been insisting a lot on Twitter, on my Substack, Palantir Bullets, on the live streams, everywhere. That is not only the number of shares that we should see, it is how the business actually grows. Because with SBC, basically you have a risk not on the business, but on shareholders. And as a shareholder, you are in a net positive position only when the business actually grows more than it is diluting. So I would not consider it anti-revenue, but I would put a lot of weight to the per share numbers when it comes to the real valuation. So what was the mistake that even I would say all the Wall Street analyst reports I saw in 2021, and the reason why I started Substack was that no one was including the dilution effect in the numbers. So people were looking at DCF without incorporating the dilution, and the dilution for a company like Palantir was very impactful. And the difference between including the dilution or not including that, and this was, I think, my second article, could give a difference between having a stock price of $14 or $8, just including a simple, I don't remember, a 3-5% dilution per year. Because that basically, even if the company makes free cash flow, if your free cash flow per share doesn't increase, that is hard to generate value for a shareholder. I took it quite long, but hope
and
I give a better
for those
context.
that want, you explained it also in your Substack. It's. I mean, Palantir doesn't really make it easy to explain, to understand, because everything is a bit different than other companies. But I believe, like, in short, as long as free cash flow per share increases, as long as the company as a whole increases more than what you would expect, yes, there's going to be dilution, but it's dilution because the business is doing well. And by the way, SBC has been flat now for, I believe, 3 quarters in a row and down year over year. So that's already an improvement, while the business is now profitable and actually going to reaccelerate or continue to accelerate now, especially with regards to commercial, but we're going to see reacceleration with regards to government as well, which in my opinion is positive. Yes, I know not everybody is comfortable with dilution. I know it's not that great, but if you look at it from a long-term perspective, It's dilution with a, how could I say this?
For a
It's
reason, I would
dilution.
say.
Yeah, exactly.
What
It's
you
not,
really don't want is a business that is keep diluting, but doesn't have a structure that allows it to keep scaling and scaling in a way that makes it increasingly better. Because, for instance, even Apple, I remember I saw, but this is not the right chart, by the way. I saw a picture of early Apple, and Apple, even if it was growing like hell, it was actually diluting like hell. But that was for a reason. It was scaling very fast, and it needed to have the best of the best of the best. And Palantir, differently from other software companies, is obsessed with the idea of I need the tier one of the tier one. And those people cost. So if you want to
of
build
course,
a Google, compete with Amazon, stuff like that, you need to have tier one people. But the key difference I see from, for instance, Palantir and other software companies is that not only they say, oh, we need the tier one people, but we actually have some hints flowing into the numbers. And I think this was not only what Carp shared in the new letter. He in the letter he showed the revenue per employee growing substantially, exactly this. We can see that it went from basically 300K per employee to almost double in 4 years. Okay, this metric is not a random metric. Is a metric that most people say, oh, this comparison makes no sense. While I think this number is one of the most powerful indication of how powerful a software company is. For the simple reason that this tells already that Palantir is not a consultancy company. And second, when you compare it with other software companies that are way bigger, like ServiceNow and Salesforce, ServiceNow is around 4 times Palantir in terms of size. Salesforce is like 10 times Palantir. Theoretically, you would expect these companies to have better economies of scale. If you look at the very big tech revenue per employee, the numbers are just insane. Something like 2 million per employee, which means that each employee is on average extremely valuable because the business produces so much money that is extremely efficient, basically, in the way it produces money. It doesn't need the people to keep generating value because they have these tier one people. So what I noticed that I think gave me the most striking evidence that Palantir was a different kind of company was exactly this revenue per employee number. Can you share my screen, please? This was one of my first articles in May 2022, when things were going quite badly, and I noticed, look at this number. The revenue per employee of ServiceNow and Salesforce are basically flat. It is high, but is quite flattish. On the other hand, you have Palantir that started at a point similar to them, despite people said, hey, this is a consultancy, and this number was actually skyrocketing. So this number alone told me, okay, this thing scales while the others, in order to keep increasing and to keep growing, they need to keep hiring a lot of people. So, for instance, ServiceNow is a perfect machine because it is growing like 30% per year while having a 30% margin. That's great. But the fact that the revenue per employee actually stays flat, it means that they are growing by basically scaling exactly what they do. While with Palantir, you have this exponential growth. So yes, they need to hire more people as well as all the companies, but the more they hire, the more they grow, the bigger the marginal effect this new employee can deliver. which is the source of not only creating something that has good margins, but something that can truly accelerate and potentially becoming viral. So that's the idea I got. But at the time, it seemed more okay. I capture that this company has something unique. It seems way stronger than it is perceived. Yet we were not seeing anything really flowing into the numbers that gave us confidence. Okay, here we are. Finally, we see this growth, and it happened yesterday, actually.
Yeah, no, I agree. I think I want to show one thing beforehand. It's this. So basically, let me zoom in a bit. So for those that didn't know, stock-based compensation has been coming down each and every quarter. Okay, in the last 3 quarters, we're basically flat, even though I believe they said that SBC was expected to go up a bit, which, didn't really go up that much. It's basically
He
flat.
said they mentioned that comment, but then they reiterated that they expect an increase in Q4. I had the feeling because they linked the success of AAP to SBC, and they basically confirmed that in the earnings call. So actually, we can consider it a good sign, paradoxically, that SBC is going to increase in Q4, because the last earnings call, they said, we will link the success of AAP to the stock-based compensation, or vice versa. So the stock-based compensation increasing further proves, assuming they are not lying, that AAP is truly going strong.
Yeah, and again, it goes back to the point. It's basically a performance-based SBC, which is always much better. And then, like, of course, it's a topic we should have to talk about. If you look at the end of the Q3 with $3.3 billion in cash, no debt, cash flow from operation continues to grow quite fast. And for those of you that aren't aware, they still did not buy one share from their share buyback program, which of course that will happen eventually. I don't know when, but that also tackles the dilution point. And as they generate more free cash flow in the future, they'll be able to buy back more shares, and then your shares are valued at more valuable. So yeah, over time, it's just a given that the dilution story will just disappear as this business just generates more free cash flow and has more cash to use for buybacks. And by the way, just because they do buybacks doesn't mean they cannot invest in the business. You do buybacks after you calculate all the things that you need to do to invest in your business and grow further. Because I know every time there's this comment, oh, why do buybacks? Why not invest in the business? You can do both. You can do both. And most of the companies do both. And unlike Apple, we are not at the stage where we're now at 4 straight declining quarters and all we do is buy back, what was it, $80 billion worth of shares in a year. It's crazy.
That slide that makes a recap of how much money Apple actually delivered to shareholders. Like the sum is like 800 billion cash returned. So basically,
it's crazy.
It's an
with
economy
dividends and buybacks.
returned into cash and dividend.
It's insane. Crazy. But yeah, I seen yesterday the Dan Ives price target of $240 price target for Apple. I was like, what? How does that even make sense? It had a PE of 29, 4 straight quarters of declining sales. Yes, services are doing much better than the hardware, but still, come on. Well, yeah, maybe he's gonna come out with another. This is the I don't know, Tiger Woods of phone makers.
This is the Cathy Wood. The Cathy Wood of services.
Yeah, it's incredible. But yeah, going back to Palantir, what was the big surprise to you? Positive and negative, whatever. Like, was like, this was something I did not expect, or this was something that came in much better than expected.
I think what surprised me on the negative side was the net dollar retention that I just mentioned before, because I didn't expect things to be so strong. Yet 7% expansion from existing clients to me is quite meh. So I can't really understand if it is clients not expanding or maybe they lost one client, one big client. I know that they lost Credit Suisse because once they got merged with UBS,
UBS, yeah.
basically I read an article that UBS didn't want Palantir. So that could have impacted. Maybe that is exactly the reason why. Hard to say exactly how big Credit Suisse was. Frankly, I have no idea. So the net dollar retention was the negative side. But apart from that, I struggle to see very big negatives. We know that Europe is struggling quite a bit. So overall, that is the negative. But it's not something that we didn't expect. As we also expect that something should unlock from the US government side. That has not really happened yet, because basically government international grew around 15%, which is actually quite nice. They said sustained by healthcare, so probably NHS, and defense, and also there they got some contracts from Spain, from the UK, and there is all the contribution around Ukraine refugees. So I think that helped. On the US government side, 10% growth is quite bad. Yet the management is very confident in saying, look, we have been investing and built this product for 20 years, basically preparing for World War III. Now a war is happening. The products that we have been building actually find their need. And that matches with what Palmer Luckey said in a recent interview. He said, the government is that kind of client that even if you provide it with the best solution that they need, until they don't truly understand and they go FOMO into that topic, they need to invest, give the budget for it, they don't really buy it. So since there is now a war, the government needs to deploy a lot of software. So wars now are not only involving hardware, but they need increasingly more and more software. That is the moment of reckoning, in my opinion, not only in the US, but I would say overall in the world. There is one comment that, in my opinion, was quite significant, more or less hidden, basically underscoring that Palantir has not just committed to help Israel, but from the comment, basically, it has already doing that. And not only by providing the software, but also to provide the software infrastructure to help other Israeli tech companies to actually work with the government. Basically, what Palantir is doing in the US with FedStart, helping defense contractors, defense tech contractors, I would say, small ventures, willing to work with the government, but which can't really afford the cost, the time to be hyper certified. What Palantir aggregated as Palantir Government Web Services. Now these companies can basically purchase compliance as a service from Palantir, especially FedStart. So basically what they have been doing in the US, and it seems it is actually working because they have 9-10 partners or even more. They are doing that also in Israel. So to me, that is a very positive sign that basically also these new things are already taking traction.
I agree. I think that's also, one of the main reasons I don't think I will ever sell Palantir anytime soon. It's because the focus, the mission-driven. He said, yeah, everybody's saying, oh, we're culture-driven, mission-driven, but nobody actually believes in that. But we're actually doing it. Partnering up with companies, with governments that actually care about safety, that actually care about the good versus the evil. I love that they're working with companies like Anduril, which I think is an amazing company. There's still a lot of noise and things that can be improved with regards to government spending in defense, letting more private companies do the work deliver better results for much less. So your spending is already going down, which can reduce the huge debt that they have. But hey, if you have 80-year-old people in the government deciding things, that's usually what will happen, bad decisions. But yeah, unfortunately, times are not that great around the world right now, but Palantir is proving to governments, to defense contractors, to allies and stuff like that, that look, we are here, we are making things work when it matters. And that will definitely deliver great results for the future, whether it's through FedStart, Palantir Government Web Services, or whatnot, Apollo, things like that. Definitely something to keep an eye on. And as Zuma said here, yes, NDR is a backlooking metric, so it's important to keep this in perspective. I agree. Like we said before, they said that NDR does not take into consideration the last 12 months the companies that they've attracted, and probably it is also low because of the weakish quarters that we had in the past. So maybe it's just a reflection of how weak the environment was, and now we're seeing the full effect of that negative environment. And maybe, probably after we've heard all the positive points with regards to AIP, things like that, we might be seeing already some results. I don't think we're going to see this already in Q4, because again, it is 12 months, a lag of 12 months, but probably in 2024, this number probably will be jumping quite a lot. So yeah, thanks for that comment. And then Marco here, with regards to the buyback, should they have done a buyback? It's hindsight. Should they have bought at 14, because now the stock is up another 4% to 18.74%, $74. Look, it was at 14. Some people thought maybe they'll do a little bit of a buyback there, but does it really matter that much? I don't think so, because I don't really think that they would have been buying $1 billion worth of shares. Probably going to be a couple of hundred millions. I don't think it would have moved the needle that much. And again, as the company becomes more and more profitable and generating more and more free cash flow, they can add more to that buyback program, which then eventually it's all about how many shares you can get off the market. It's not a one-time thing, but yeah, the cheaper the shares, the better it is, because the more they can be buying. But yeah, would have loved it if it crashed to $8 and they bought all of it, but did not happen. Yeah,
that's the perspective how I also look at it. That the buyback should be considered an option to basically capitalize on potential irrationality on the downside. I consider it is actually good that they didn't buy shares now, because, for instance, when they announced the buyback, just the day before, I had a video reaction on Jeremy basically making fun of what I said, because I said it would be absolutely stupid to make a buyback. Jeremy said, "No, look, the best way they should make a dividend or a buyback," and I reiterated, "That's what are you saying?" And then the company came out with a buyback. But you see, coming out with a buyback is more okay. Market, if you are irrational, I'll capitalize on your dumbness. It's not that I will buy at any price. And that's something, a playbook I noticed from many companies. You announce it, you are ready. If the price drops substantially, you're actually happy because you purchased those stocks. Like Airbnb, I think it is doing it very, very well. I actually at the point where I wonder how come the market has not noticed or appreciated that yet. But eventually, maybe it will happen. So the company needs to buy back exactly in the way a potential shareholder should look at an investment. So at $14, is the price truly a bargain compared with fundamentals. I would say in this range, let's say 15, 12, that is something that I don't consider it extremely expensive. I don't consider it truly appealing. So maybe, yes, in insights, 25% gain would have been nice, but it means that neither Palantir considered it that appealing. Or maybe but by that time, it neither touched $14. Now I don't really see the chart, but when they announced the buyback initially, it was more in the $17 range or even above. So we can look at it as Palantir being disciplined after being completely, how can I say, not irresponsible, but I would say quite degenerate with SPACs. I mean, it is true that SPACs were not only a financial investment, there were a lot of R&D that they capitalize on, yet in terms of where they put the money, what kind of shares they actually got, the final effect of almost all these shares basically going to the toilet. I see that as Palantir becoming conservative, and I appreciated that. And I would say if the rates were still zero, it would have been actually a very good move to buy back at $14. With the rates at 5%, that extra 150 million for free, completely risk-free by doing nothing, basically are nice to have.
I agree. I mean, it is a luxury. Of course, if I have to choose buybacks or dividends, I would definitely go for buybacks, better for tax reasons as well. But I mean, they're probably going to buy back $1 billion worth of shares. I don't know when, but it will happen. Maybe that pile will also probably grow as well. So yeah, I understand that now that the price is closer to $18, $19, and people are like, oh, but they could have bought shares at 14, 15. Okay, fine. Could have. If they announced the buyback 1 year ago, they could have bought it at $6. So yeah.
We could have gone completely all in at 594. We didn't.
Exactly. Could have. If we could have done a lot of things. But yeah, I want to ask you a bit about this one right here, the average trailing 12 months revenue per top 20 customer that increased 13%, which I believe is better than the overall, than what they expected before, the growth rate before. Maybe I might be wrong, but wait, it's not even showing this one. So top 20 top 20 customers, are they getting too concentrated in your opinion, or is this just a result of, well, just the environment right now and the biggest clients are just in a better position, and this number will be a better reflection in the future of this situation?
I don't think there is too much concentration, and I would reply with this other chart that I like to track. When Palantir went listed, it was in 2020, and back then, basically, you see that the top 20 clients were impacting really a lot. Actually, in 2019, the top 20 customers were basically 2/3 of the existing revenues. And gradually, this percentage of contribution decreases, implicitly saying the top 20 clients keep scaling, and they probably contribute to the most of the earnings, because when a new customer is acquired, initially the contribution is negative. So Palantir absorbs the cost, but the money coming in is not really high. But once a customer reaches this $40-50 million per year on average, then it starts becoming very, very lucrative. So basically, this component, that is the green component, is what allows Palantir to finance the acquisition of the other customers. And what's really nice is seeing these remaining customers gradually growing. And since once we intersect these with also the other slides, it is a combination of many more customers acquired, especially on the US commercial side, and the existing customers gradually improving. And the net effect is, if you see on one chart, the top 20 customers on versus the total customers, basically you see this divergence. The top 20 customers keep increasing in terms of average revenue per year, and the remaining staying flat. But since the number actually of clients keeps increasing, it means that the existing previous customers actually are increasing. Just the increase is then net when you calculate the average, because there are many more customers flowing into. I don't hear you. I think you're on mute.
Yeah. They said like they remain focused on landing new accounts. So again, it's a thing that we're going to see the full effects of their great execution and work probably 12 months from now. I know a lot of people will be like, oh, next quarter, 2 quarters, but the full effects will probably be 12 months from now. You're going to see a huge difference between what we're seeing today with Palantir to what we're going to see Palantir at the end of 2024. I mean, at the end of 2024 in the United States, there are elections, so new president or not, I don't know.
What do you expect it happens now in 1 year from now?
From Palantir standpoint or from the US government standpoint?
No, from us as investors. So we are not here trying to trading the stock, but I would be curious of how you see the business evolving and the related perception on the business, which is what basically determines how also the stock is perceived.
Yeah. So first of all, we know it's coming. It's the NHS. I mean, that's going to be a big one, regardless of how you look at it. I mean, we had a couple of government contracts also that are in the hundreds of millions of dollars. So it's not about really the money, even though the money is great. It's about it's about the message that we're sending out. Getting the NHS, despite all the crazy headlines, the lies that were told about Palantir, oh, they're selling your data, there's no privacy, this and that, even though probably the majority of the people complaining are on TikTok, are on Instagram, Facebook, you name it, where their data is really not that safe at all. And at the end of the day, it's about making your life better if you're sick or whatnot. It's about making hospitals more efficient. I mean, they've proven it during the pandemic. They've made it much better for people. So yes, if you have to agree that a couple of data points will get shared with other practitioners or whatnot, so be it. I mean, you have to give something to get something in return. But a year from now, we're going to see better numbers in commercial. I mean, that's what they've been telling us. I think commercial is going to continue to accelerate. And yeah, government right now is very weak. I mean, our favorite analyst was still with his $5-6 price target because government is not growing anymore and Palantir is going nowhere, blah, blah, blah.
We can't rationalize how Palantir deserves to be at premium.
Yeah, okay. I can't rationalize why he still has a job, but okay, I've seen crazier things.
Well, for me, it's striking thinking I was literally crying to get into hedge funds, research positions. Nobody wanted me. And basically now I'm making a living by kicking the asses of them.
It's crazy because people think that these big financial institutions have the smartest people. I mean, we've seen in the last couple of weeks that the big educational institutions have lots of idiots in them as well. At the start of this year, I was interviewing at one of the biggest Swiss private banks around, and they had a question, pitch us an investment idea. So I took Tesla, because back then Tesla was at around $110 or so. Like an elevator pitch, very clean, normal pitch. The questions that they had were so stupid. They were like, questions that you would think that people that just read the headlines from I don't know, Yahoo Finance or Market Watch or whatnot, where the doomsday scenario, supply chain issues, there's no demand, it costs too much, blah 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 blah. And I was like, you understand that supply chain issues is an issue worldwide, right? And you also understand that Tesla is a much better financial situation than all the other competition. You also understand that the Model Y is going to be the best selling car around. They're making record profits. Back then, the margins were also much higher. So I was going on and explaining all these basic things about Tesla. Yes, they focus on the traditional metrics with high PE, stuff like that. I was like, why? I mean, you would have missed so many great opportunities in the last 20 years if you just looked at the PE. Look at profit, look at free cash flow, look at the margins, look at how the competition is going, no debt or close to no debt. And I was like, if this is one of the biggest Swiss private banks around, no wonder things aren't going that great. And yeah, I mean, 2 days
Well,
later, I send them a message. I was like, okay, never mind.
no, but
I've got better opportunities.
this is the big paradox. Is basically if you are too in depth to what you are supposed to do, that is not truly understood, because even this analyst covering Palantir, apart from Mariana that actually understood what Palantir is, the other guys only look at the metrics, because the metrics are like what gives you confidence when you can't really understand the business. Because it's safe to say, oh, but yeah, revenues were decelerating, oh, but the dilution, or but. So you anchor to these last numbers, because that's the only thing that you can say. Understanding the business is actually way more difficult. It seems you're wasting time from that perspective, because you as a financial analyst, you're supposed to study more the numbers. But the harsh reality is that unless you truly study the conditions, all what's around, starting from the culture, the product, how customers react, what customers want, why this company is differentiated, you can't understand how the numbers are generated. Therefore, you can't really understand how these numbers will generate in the future. So that's why analysts and Palantir only looked at that from a linear perspective. This company grows X, so it must be valued as Y. While I think as smart investors, and I would say retail investors, have been way smarter, maybe they don't know anything about valuation. I think many didn't even know how to read income statements, didn't really know what a number is. So what do you do in this case? And I think that's exactly what also helped many Tesla investors becoming millionaires, is not staying anchored to the numbers, but they looked at the first principle. Okay, what the company does. Okay, how good is the product? Is the product appreciated? Does the product actually deliver a lot of value to someone who purchase it? Is the customer happy so that it wants more? Okay, these are the things that the Tesla investors saw. They saw it more easily because the car is there, is beautiful, you can test it. And is what Palantir investors saw in the early days. And probably it came out from an instinct reaction. Hey, this software company is a software company like many others, but it's the only one solving such big problems. Pandemic, war, these are not small projects. These are insanely important, critical projects that if you're able to solve that and the big tech can't, there's something weird in this company, combined with also the weirdness of the management and so on. But these intangible things are the reason why I'm not a millionaire with Tesla. And I got so triggered because I realized that Tesla was an alpha company. That's why I called that article Seeking the Alpha, because I'm obsessed with this idea of seeking the alpha company way before they are realized. Everyone agrees. Everyone agrees now Tesla is an alpha company. But back then, when I discovered it in 2004, I initially studied it. In 2015, I made my very first moves as an investor, and I actually was trading Tesla like here and there, like with technical analysis, like madness. But I realized, okay, this company is actually unique. And once I had more technical background, I made my master in finance. Then I was an analyst, so I played more with the numbers. I thought, oh, this company is uninvestable from an investing standpoint. It burns so much cash, it dilutes so much. Basically, I put the money in, and this capital gets burned between cash burn and dilution. That is uninvestable, even if I think they will make it. Every people I knew, I was, oh, no, but Tesla, even with my roommate, we were spending nights talking about Elon Musk. We saw the live stream of the Model 3 when it was announced. So I was following the story. I was aware of the story, but the fact that I was so anchored to the financial analyst framework, I completely missed it as an investment. So I promise myself I will never ever do that again, and that's what I'm doing with Palantir. I use financial metrics to, for instance, when the price was very high during COVID, it's on the 20-30 range with crazy multiples. I was not touching it. Like I had my position, I started at 10, and I didn't touch it until the stock went again below 10. So was disciplined using financial valuations in order to avoid huge mistakes, but I didn't anchor too much. I realized I'd better be grossly right rather than precisely wrong. And as an analyst, the propensity of being precisely wrong is huge. So the fact that we are being here discussing not much on, oh, but should you use a WACC of 11 or 12.2? And that's what analysts do, by the way. That is what truly matters. Understanding the conditions that drive the numbers. If you have a sense with that, then you don't need to be precise because you get the direction. And for instance, with Palantir, I'm confident in saying now the direction is 10x better than the direction that we had last year. Last year, we know the company was valuable. It wasn't perceived as valuable, but there were no hints that the company was going to be recognized as valuable. Now, all the things that we have been seeing start being seen by everyone, and now they are flowing into the numbers. There is this moment. Who could have guessed? Only the people who made the homework like us. Monologue.
Drop the mic. No,
Oh.
I agree. I think, Peter Lynch, I believe he said it, to analyze companies, to start investing, you basically have to have basic math. You don't really need to learn about reverse DCF, stuff like that, because by the way, at the end of the day, that spreadsheet, you can put in whatever numbers you want until you reach the number that you want to see on as the result. And I believe you put a video of Peter Thiel talking about, when something goes down, you're like, oh, it's the end of the world. It's the end of the world. Everything is going to zero. Then when things go up, you don't really understand why things go up because of your thoughts and your way of thinking. And yes, it's true. A year ago, Palantir was not in the best position, so it didn't deserve to be at $18 like it is today. But then after a quarter or two, it did not deserve to be at $5-6 either. And analysts probably did not think the same way we did. They were like, oh, nah, we still need to see more and more and more. And that's where individual investors can have the big advantage on traditional Wall Street and other people. But going back to what you asked, where are we going to be in 1 year from now? Again, commercial continues to grow. US, I don't really count a lot on Europe. I think Europe is going to go through more pain, unfortunately. Then with regards to government, definitely reacceleration of government. Yes, even with the elections at the end of 2024, whatever happens, I think governments are going to understand that they need to go through better ways of spending, not just for defense, but for everything else. So they'll have to make use of those privately led companies. Not privately, but Palantir is a public, but still it's not a government company. So yeah, government goes up. US, I'm talking purely US, even though maybe some allied countries are going to make use of that. But yeah, 1 year from now, definitely a better place than we are today. Unless worst case scenario, there is a world war, but then yeah, I'll have other issues to other things to think about than my stock portfolio. But yeah, 1 year from now, definitely Palantir a better endpoint than what I would have thought 1 year ago. But yeah, a lot of things can change as we've seen. I mean, since 2020, I feel like the world has gone through roller coaster after roller coaster. It's like a horror show.
But
But
that's why you need a company like Palantir that is a tech, but the reality is that is diversified in all the sectors, and they start with the idea that chaos happens, chaos is here. Therefore, the fact that they solve chaos puts them in a very interesting position. So I personally love this idea of anti-fragility. That's my favorite book, probably. And in Palantir, I saw exactly like that. Even with a war, potentially, I'm not hoping for a war, but potentially even with World War III, this company becomes better because it can help deterring first, and in the case it happens, actually manage it. But let me ask you, if you have to guess a number for last quarter of 2024, how would you see Palantir? Like, what kind of growth and margins you see? Because I asked because I have an idea, but I don't want to influence you.
so we're now at what, closer to 30%. Before was the 25% ish margins. I don't think we're going to go like much higher towards the 40% just yet, in my opinion. I think we're still going to go around that 30%, which is fine as long as it continues to grow. Free cash flow generation will probably increase, in my opinion, as we get more and more of those lagging indicators going to be baked into the business, which again, I don't expect these things to explode 1 year from now. These things take time. These contracts are also like contracts that last a couple of years. But we're definitely not going to be at the 1 cent or 3 cents now of earnings. We're probably going to be, in my opinion, higher than that. I wouldn't say like 3 times higher, but wouldn't be surprised if we see like 5 cents a quarter or so, or things like that. But yeah, those are basically the numbers, still around the 30% margins. If they can go higher, great. But we're talking about 1 year from now. There's still a lot of things to go through. Even though this company, yes, like you said, is a company that really benefits from tough times. It also benefits when times aren't tough anymore, when rates are lower, when companies are ready to spend more money on software and things like that. And I think, I mean, we saw the report today before the market opens. Unemployment now at 3.9%, which is getting like very interesting because things are reaccelerating in the wrong direction, which is great for the stock market. But not that good for the economy, which yeah, remains to be seen what Jerome Powell is doing. In my opinion, I mean, he would be. It's, how can I say this? If you raise rates one time now, it's not going to move the needle at all because we are already so high. We moved so fast. I don't think one extra will do the trick for them to get back to 2%. Blah blah blah. But the positive effects of not raising or maybe even cutting, even though I think cutting is going to be a bit too soon right now, will have a better impact than just raising for the sake of raising because, oh, the numbers here in real estate or whatnot are still not where we wanted to be, which, by the way, also they're looking at lagging indicators, lagging numbers, which is not that great. I mean, 2 years ago, they were like, oh, inflation is transitory. And now they're like doomsday scenario, everything is going to shit. So yeah, I fully expect rate cuts in 2024, which is definitely going to help software companies. So maybe that might reaccelerate growth. But again, I don't think we're going to see this in Q4 next year, maybe 2025.
Well, I asked you the last quarter because That's the closest to 2025, which it seems it should be the key year, because that is where the first guidance ended, and that was a general expectations of, okay, in since 2020 you collected a lot of clients. Let's say it takes 3 years on average to get the clients really big. On 5 years horizon, the customers that you got in 2020, 2021 should be very big. So I actually think but this is my pure speculation, so don't take it for granted or a financial advice or any way. But I'm starting thinking that potentially in last quarter 2024 we could see something wild, like 30% margin, so 25-30% margin. I think they want to keep that unless they find a way to really deploy cash in an effective way. Bootcamps are cash light, are only employee intensive. But the revenue growth, I think there is enough basis to see a very strong acceleration. So I think by the end of 2024, we could see that 30% growth again. And the reason is not simple, but can be deducted from simple reasoning. If the government side is contributing a lot, but has not entered the number yet, it means that probably we could see like some big bombs coming that could generate a shift. Like when COVID happened, basically the government side of Palantir got a big boost that pushed the growth. So basically there is this contribution that is not entered the numbers yet. So if you put the numbers of the government side reaccelerating to around, let's say, 20%, 25% growth, that is already a very good balance. But it seems the commercial side can actually accelerate more than 30%. Basically, my intuition, and it will be nice to see in 1 year from now, my personal expectation is seeing the government reaccelerating to 25% and the commercial side to around 35%, basically creating a match of around 30%. And the reason is if we exclude the SPACs, the the revenues from the commercial clients are actually very nice, in the zone of 25-30%. Specifically, US commercial, it is growing 55% right now, which is insane. So it is contributing by a lot. And the number that probably stuck to my head the most, because is the most what we have number, is okay, US commercial growing 55% year on year. How's it call it? Quarter on quarter. Subsequently.
Yeah, sequentially, yeah.
Sequentially, 19%. 19% quarter on quarter means 20% times 4, almost 80% that growth annualized. So if US commercial keeps this growth, we could see something completely wild. Now, not a guarantee it would happen, but the fact that you have 19% quarter on quarter over 55% year on year, it means that is truly accelerating. And once these things accelerate, they can accelerate really a lot, because if you become a standard, so like the early days of Salesforce becoming the standard of CRM, you can have very, very strong growth for a long time. So that's my speculation. Again, happy to be proven wrong in both directions.
Yeah, no, but I think, I mean, looking at what the indicators that we're getting right now, it wouldn't be too crazy. It wouldn't be too crazy. But even if it's a bit less, I mean, we are in a much better position right now than before. The fact that we are becoming more and more profitable while growing, while attracting more talent, while attracting more customers is already a big deal, which goes into probably the last question here. S&P 500 inclusion. When do we think this is going to happen? Because of course now they're eligible for that, but we know these things. I mean, we can only guess. And do you think that the fact that they are eligible for that inclusion is one of the reasons why the stock is on the rise? Of course, not only that, but it probably has a small impact already.
I think the inclusion, well, the eligibility for the inclusion is helping the stock, but is not the key driver. I think the key driver is people waking up that this company is not only a good company. 1 year ago, it was a meme, trash, unprofitable company. Now people are waking up, hey, this is actually an AI company set to benefit from 10 years of hyper growth. This is a GAAP profitable company. Actually, I printed this t-shirt when they became GAAP profitable. Now I would say super GAAP profitable because 13% growth, 13% net profit margin, it is actually very good. It's actually probably higher than that of ServiceNow right now, even if it is bigger. True, helped by a lot of net interest on cash, which contributes like 6% of that. Fine. But still, 13% net profit margin, which is very close to 15% margin if we assume the guidance for Q4. That is already a very well-respected net profit margin. So Palantir is officially both maturing and set to grow. And I think people are starting to have a sense of that. I can't say people are understanding it, but at least once you see the numbers, actually, I'll show you this other chart that I made and makes me super excited when I plotted. Basically, what Palantir has been doing is growing the revenues while keeping the R&D, including the SBC, even basically flat. And we have more and more evidence that this capped R&D didn't come by compromising the quality of the research of the products. So they are effectively creating a very strong operating structure that has a lot of leverage inside the business, meaning that the costs are kind of fixed and you can grow the top line, so the revenues, by having basically marginally better and better margins, which on the other hand, it means there will be always more and more cash flow that can be deployed to sustain that growth. So I think we went from a company that had a lot of question marks on it, from what the company does, what the CEO says, what the company is doing, to, whoa, this company is accelerating. It is producing a lot of free cash flow. Now even GAAP profitable. They're set to rise in a very high, strong demand environment for many years. And they're even set to benefit from the, I would say, imminent defense spending in tech. At this point, it is clear that you can't fight wars or even deter wars just with pure hardware. You need a software component. And guess what? Not many companies provide that. Palantir is the only pure tech company providing those solutions. The other big tech are just focused on the infrastructure side. They also deliver some software, but that's not their core mission. So I see it's like the moment of reckoning when Tesla started to becoming GAAP profitable, and the people started switch from okay, this company is trash to hey, wait a second, this company is actually proved that the thesis of EV becoming a profitable business is actually true. So and not only is profitable like Palantir now, but they're actually growing and increasingly growing. So once you have this Lulapalooza, which is a manga term defining a combination of favorable factors that merge all together, creating this method of positive catalyst. that is where basically you have that moment of wow, and good things happen. So that's my thesis. Obviously, it can be wrong. Everything can happen way slower than I expect. Yet, in 3 years, I've been studying Palantir very closely. I've never seen such a very strong combination of factors that makes me confident on the business. If I have confidence in the business, the stock is just a tool that reflects the perception of that moment. I'm not in a hurry to sell unless I see stupid stuff. I reduced the position earlier during the year when I saw the stock mooning and not being backed by the fundamentals. Now I see the stock mooning, but it is heavily backed by the fundamentals. And it is not cheap. It's not cheap in terms of multiples. If you make a DCF, you need to be generous with the estimates. But it is true that the dynamic, like the engine that creates the number now, is extremely valuable, while last year it was fair to have many dubs.
I agree. I think it's important to have. I mean, it's important to have great management with a good vision and execution that lines up with the company's missions and goals. Because lots of companies these days, unfortunately, turn into activist companies, and then the company just doesn't work anymore, and the stock reflects that. And then of course they have to change it to reward the shareholders, investors, activist investors, you name it. With Palantir, I mean, listening to Alex Karp talk, of course, sometimes it's a bit weird, but I mean, he's very mission driven. The company is mission driven. They know that their software is saving lives. They also know that it's software. They're not going to go after hardware. They said this in the earnings call. They're helping companies make hardware better, more efficient. Talk about ammunition, BP, stuff like that. So they know what they're doing. With regards to the valuation part, just to end on this note, if we look at the mean, it's still a bit lower than the mean since the end of 2020, but it's getting pretty close to that mean. If you look at PE, V to EBITDA, price to sales, price to free cash flow as well. So yeah, it's not the cheapest company that you're going to get right now. But yeah, just so you know, this is currently the state of the company, close to $40 billion in market cap. And yes, we have some great momentum. We have some great momentum with regards to the company, with regards to the stock as well. But like you said, the stock is just a way for us to be rewarded in the future. What you want to see is continued execution by the business, by the management, and then the stock will do what the stock will do in the short term. I've said this with countless companies that, well, I mean, for example, PayPal, valuation-wise, it makes no sense. And just execution is key here. I mean, the earnings call was great, but again, talk is cheap. Execution is where the money is at. We'll have to wait and see. With Palantir, again, we had some weakness. We now have some strength. I'm sure if the stock drops 10% in the next 5 days, people will say, "Oh, what's going to happen? What's happening here?" But remember, you buy a piece of a business. You don't buy a piece of a ticker symbol and a stock. So yeah, if you want to add something else, now is the time.
No, it's well, I had enough monologues for today.
All right. So thanks again to everyone that has been tuning in. If you'd like to see more of these videos, let me know down in the comments. Go follow Arny on YouTube, on X. All the links will be available in the description, in the pinned comment. And I hope you're all you're going to have a great weekend, great end of the week. It's been especially a good week for stocks. Earnings season has been okay, I think, this so far. So thanks for listening, and I see you all in the next one. Bye-bye.
Thank you. Ciao, ciao.